So to spotting trends is obviously in some ways subjective because it's a lot of opinion, but there are certain patterns. So we do get data from research. We get data from asking existing clients, for example, what sort of ingredients are you looking for? What type of products you're looking for? We do read a lot of its research that's publicly out there as well. And also you sort of sense trends. Trends actually appear out of nowhere. If they are successful trends, they'll be going viral, perhaps with TikTok or Instagram. You'll see people start to talk about various types of products. So we're always looking for A, where there's obviously progress and growth and people talking about it, but B, where there's not much competition or there's, a category that perhaps lacks innovation. So, we're looking for those sectors that are a little unloved sometimes, because obviously there are categories where the big players obviously have so many products, so many ranges, it's very difficult to compete. But there are many, many sectors in drinks and in snacks and in foods that have gaps. Question about then the tools for growing it are obviously trying to leverage and grow KPIs, if you like, by how many units per store per week is a product going off the shelf, for example, or how many times is a customer repeat buying online. These things are really important to track the stickiness of the repeat business and how we would grow. Are they likely to tell friends about it, for example? We're looking for those sorts of run rates to invest in. So, well, for starters, we do have capacity if we were to grow fast. We're in a good position on that perspective. The reason for having them as separate limited companies is that, for example, when we looked at the Shawbrook financing, they really wanted to look at a clean P&L, which was specific to a brand. It was a specific business that had its own life, if you like. The public company has costs, for example, which may skew the way we present margins and the way we present the success of a business. And also, there are risks. There are always risks in food companies. If anything happened, it's quite important to isolate that problem and not perhaps have it bring down the other companies, for example. And also, if, let's say, Oaf doing really well, it's hard work out there, it's going to take some time. But let's say in 3 years' time, that is a runaway brand. We're doing 40 million sales. It's worth 200 million. Hovis want to buy it, or some big strategic wanted to buy it. It's quite neat and tidy to have it as a separate package. That said, sharing infrastructure, management teams and finances, of course, and leveraging in cross-fertilizing and obviously helping each other with cost control, etc. But ultimately, having an independent P&L, I think, is quite important for those reasons. So, firstly, the Shawbrook refinance, we did have a bullet repayment in 2026. That's now been removed, so that we've now gone over a much longer term. The 3.9 million refinance includes no bullet payments over the next few years. So we've steadied the ship in terms of that ticking clock, if you like. And the rationale was to settle obviously that original facility, but also to raise a little bit of extra capital at reasonable rates with a great bank. They've been very supportive to us over the years. They helped us actually finance the acquisition of the company originally, and it gives them a bit more bandwidth to be aggressive. So we want to do a lot more promotions. We want to do more, obviously, social media and PR, and we've been working really hard on launching that brand. And also, we'd spent quite a lot of money on building out a new factory to make some of those products alongside our existing factory, but that obviously took capital investment and used up some of our cash resources. So really what's happened now with the Shawbrook refinancing is it puts Oaf and Juvela on a really strong footing, able to grow, able to keep up. Yes, absolutely. What we do have is we have proven products in good industries, and the more firepower we have, the faster we can grow. And we would distribute in new places, we'd be aggressive with promotions, we would drive innovation and launch new products, and we would employ the best in terms of skill sets and everything. And these businesses do rely intensely on capital. So if we had money to go and make acquisitions, a lot of spare money, and we were looking at what would we do next, we'd be looking at certain parameters to prove that the investment is worthwhile. And a few of those items might be, for example, obviously, has the brand been around for a number of years? Is there repeat business in the brand, which we touched on earlier? Is there at least some level of major retailer? Holland & Barrett, a Tesco, Sainsbury's. Is there any of those that have actually stuck with the brand for more than a year or two? Because obviously there are challenger brands that come and go. So we would be looking at what stayed on the shelf, what has repeat business. Is there obviously a buzz social media wise, online? Are people liking it? Are they becoming, raving fans, if you like? And also, we've seen a lot of businesses that might be doing, 5 million revenue, all D2C, and then suddenly the cost per click of acquisition has changed, or the margins have changed, and it's quite promiscuous online. So we like to see longevity of shelf space and repeat business. And then obviously a brand that looks good, tastes good, and is as in a certain sector that we believe will grow. And there's lots of opportunities out there. And, as an angle, if you like, or a strategy that we have is basically in very, very simple form. We want to go and look at buying free from brands and consolidating them, in that free from wellness category. There are lots of them, and we would have quite strict criteria before we would make an investment. Yeah, I mean, it's obviously in a way how low can it go, or what can you get away with, and can you drive value? I think the value is sometimes created on the in. You need to be buying at a decent valuation. Finance, we've in the past borrowed a multiple of EBITDA. I think borrowing more than 2 to 3 times EBITDA is too risky, and I think that you'd be paying a big premium for it. So never really paying more cash than a multiple of the 2x EBITDA, let's say, although we would favour paper. Now, the other problem with paper, of course, is that with the low valuation, which we believe we have, we don't want to be issuing too much paper. What we'd like, obviously, is a higher valuation, and then we would look towards paper instead of cash. I think at the moment there probably is unprecedented opportunities to be buying simply with a little equity, a little upside, and a lot of businesses that may not be making money where we wouldn't be necessarily paying much cash for, but we would need working capital, obviously, to turn them around. When we bought Juvella originally, it was making decent money, and we financed via Shawbrook, and we paid a multiple of EBIT. We borrowed a multiple of EBITDA. I think with very stable businesses, we would be looking at cash out to shareholders, but unless they're very stable, we wouldn't be looking at cash out to shareholders. We'd be looking to support founders that would come in with some public company upside, a bit of liquidity, some resource and teams to work with, and we would help add value to those brands. Ideally, obviously, as majority ownership, because ultimately we're an operating business. We're not an investment business. Yeah, so what we'd like to be obviously achieving is we'd like to look at acquisitions, and when we get them done, we will be announcing them, and we have a lot to look at. Also, new retailers and new distribution wins for our existing products is an important KPI, if you like, and also new product design. So new products, innovation that we're launching. We've obviously announced the launch of Oath recently, which is a really exciting brand. We put a lot of work into it. We are working very hard now on a refresh with Pulsin, and we're looking at new types of bars and new types of powder supplements, and looking at other categories, if you like, but utilizing the brand. So those are the sorts of things commercially that we will be focused on and hopefully be announcing as we go through the year.